Hello, and welcome to the lesson on alternative minimum tax. By the end of this lesson, you should be able to identify when AMT is applicable for individuals. This lesson covers a tax that affects many higher income taxpayers. Alternative minimum tax was originally created to make sure that all taxpayers paid their fair share. And at this time, it was possible for wealthy taxpayers with very high incomes to pay little or no tax. Congress felt this wasn't fair, so they instituted this system whereby some of the previously used tax avoidance techniques would be added back for alternative minimum tax purposes, therefore hopefully helping to make sure wealthy and high income taxpayers paid their fair share. Now, over the years, it has become a middle class tax more so than a upper income tax. And that's mainly because when AMT was created, the numbers were not indexed for inflation. And each year, Congress would have to make those adjustments for inflation. And the adjustments that were made just never really kept up. And so it ended up that middle income taxpayers were having to add things back. Their exemptions were being phased out. They were subject to alternative minimum tax. But the taxpayers with the highest incomes actually ended up not paying alternative minimum tax because their regular tax rates ended up being higher. The recent tax law has changed this a little bit, and so I predict that fewer taxpayers across the board will be paying alternative minimum tax, but we'll just have to see what the next few years brings. It's also important to remember that alternative minimum tax is mandatory and it is a modified flat tax. So if you remember from week 1, we have 7 marginal income tax rates for ordinary income regular tax purposes. There are just 2 tax rates for alternative minimum tax. And I'll also elaborate a little bit more about alternative minimum tax being mandatory. So maybe back in the 80s, when AMT was first created, the IRS's computer systems couldn't really keep up with all of the new calculations, or at least they weren't recomputing each taxpayer's alternative minimum taxable income and tax liability. That has changed. So it is important that if you are preparing individual tax returns, and even more important if you are planning for individual income taxes, you make both of those calculations. Because on the preparation side, if you're manually preparing the forms, or if you're using a software where you can turn off the alternative minimum calculation system and you send in that tax return without the AMT forms and schedules, or at least it not being calculated, the IRS will take the regular tax information that you've submitted and they will compute alternative minimum tax for you and send you a bill. So it is important that you make sure, certainly when you're preparing individual tax returns, that you have that parallel calculation turned on, or if you're doing it manually, that you're making that calculation as well. And then it's even more important when you're planning that you take alternative minimum tax into consideration. So when you're making those planning calculations for regular tax purposes, you want to make them for AMT as well, because we definitely don't want to do things just for tax reasons. They should have other financial intangible reasons behind them. But if you advise a client to do something and tell them that there will be a tax benefit, and then when the tax return is prepared, you find out that there wasn't, that is definitely not a good feeling at best and could be considered malpractice at worst. So it is very important to make sure, for planning purposes as well as preparation purposes, that you're making these calculations. As I mentioned, everybody needs to run both tax calculations. Basically, you run the traditional tax calculation that we've been spending the last 6 weeks discussing and learning. You take that regular taxable income and you add back a few things, you make a few calculations, and you come up with your alternative minimum tax. If alternative minimum tax is higher, then you're paying AMT. If regular tax is higher, then you're not subject to AMT. You take the higher of the two. While you do take that regular taxable income and you add back what I call the good stuff, there is a base exemption available for alternative minimum tax. If there weren't, then everybody or many people would be paying AMT because you're just adding back things that were deducted for regular tax purposes. The base exemption is determined by filing status. It is also indexed for inflation, so refer back to your textbook for the current numbers. Furthermore, this exemption can be phased out. So if a married taxpayer or a single taxpayer or head of household has significant income such that that exemption is phased out, then they are more likely to come into alternative minimum tax because the exemption can go away completely. Some of the things that are added back for alternative minimum tax purposes include the standard deduction if you're not itemizing. So if you're taking the standard deduction for regular purposes, that's added back. But if you're itemizing, not all of your itemized deductions are added back, just some of them. The most common deduction that is added back is state and local taxes. Not so common is non-qualified mortgage interest, and I say it's not as common because for AMT purposes, it's just the mortgage interest attributable to the piece of your loan that was in excess of your original loan. So if you refinanced and you cashed out, the interest attributable to that cash out piece is going to be considered added back for alternative minimum tax purposes. Believe it or not, this used to happen in the first decade of the 21st century, not so much now. We'll see if that happens again, but it's important to be aware that that is an add back. Another common add back for alternative minimum tax is depreciation. So if you have a business that is reported, say, on a Schedule C on a personal return, if you have real estate, rental real estate, that is reported on a Schedule E on a personal tax return, or if you have depreciation coming through a business that's reported on a K-1 from an S corporation or a partnership, all of these can yield some AMT depreciation adjustment differences. And just in a nutshell, the difference is for regular tax purposes, typically you can use double declining balance, 200%. For AMT, you can only use 150%. Real estate is mostly the same for alternative minimum tax and regular purposes, but some real estate is depreciated over 40 years as opposed to the 39-year life. So those are some less common adjustments. Of course, people who have rental real estate are going to see these adjustments, but not everybody has rental real estate or K-1 investments. A couple of other things that are not as common to be added back for AMT, but they can be significant. If you have a depreciation difference for AMT purposes, that as we talked about on the last slide, we'll remember from our week when we talked about basis, that means we're going to have a different AMT basis when we go to sell those assets. So the gain or loss from the sale of depreciable assets may be different. It may be positive, it may be negative, but that's an adjustment for AMT. And then also, if you have a taxpayer or a client who has incentive stock options, now this is different from non-qualified options, so you have to be familiar with the type of plan that your client or your taxpayer is under. But if these are incentive stock options, which means no income for regular tax purposes in the year exercised, the bargain element of that incentive stock option does need to be added back for AMT. And in the real world, I don't see incentive stock option plans as often as I used to, but when I do, quite often, I see clients being subject to AMT because that add back tends to be pretty significant. So that's something to watch for with your clients who have stock option plans. There are two types of adjustments for AMT. One is preference, and the other is an adjustment. The preference is something that is permanent. So you add it back and you'll never see the benefit coming back to you in a later year. An adjustment is something that can be positive or negative, and that's like depreciation. So depreciation may be added back 1 year, but eventually it gets subtracted because it's just a timing issue. Adjustments are timing issues. Preferences are things that are going to be added back, and you will never get the benefit for AMT purposes. Some common preferences include tax-exempt interest on private activity bonds, accelerated depreciation on property acquired before 1987, still listed in the code, but you're not going to see that much anymore because 1987 was a long time ago. I'm sure I don't have to tell you that. And so all of the property that has been placed in service is pretty much depreciated by now. Some of the oil and gas preference items. So oil and gas has depletion. It's like depreciation. It has its own set of rules for regular tax purposes and for alternative minimum tax. That will be added back, and there'll be no adjustment later on. And also net operating losses. Sometimes those are permanently disallowed. So let's talk a little bit more about that tax-exempt interest, the private activity bonds. So again, it's not all tax-exempt interest that is added back for alternative minimum tax. It's just for private activities, private enterprises that do get tax-exempt status for certain bonds. So if a city or a municipality, a government wants to encourage a business to relocate to a certain area, we've had a few businesses in the news lately having competitions for where their next headquarters will be. So if part of that incentive package for those businesses is to let them issue tax-free bonds, those will be tax-exempt for regular purposes, but not for alternative minimum tax. And typically it's not the business that is issuing the bond, but maybe the city says, we will put in new mass transit, and they issue bonds. Or we will, a lot of times it'll be a stadium. We'll build a new stadium, and there'll be some private activity bonds. And typically you'll see this reported specifically for you on the 1099. So you don't have to guess at it. It will be reported for you to use for tax return preparation. It also will be reported to the IRS. So again, IRS has that information. If you fail to enter it in your tax software, they will let you know if it makes a difference. So if you do have tax-exempt interest on private activity bonds, it has to be added back. If there's margin interest or investment interest associated with carrying those bonds, that interest is not tax deductible for regular tax purposes because the income isn't taxable, but you can deduct that interest for AMT purposes because that income for AMT purposes is taxable. Oil and gas interests, as I mentioned, depletion is something similar to depreciation. Excess percentage depletion is great for regular tax purposes, but it is an adjustment which is permanent for, it's a permanent adjustment, and excess intangible drilling costs are also a preference item. Net operating losses. We have talked about net operating losses in the past. It is possible for an individual to have a net operating loss. Now, that net operating loss does have to come from business activities, so either from a Schedule C or from a K-1 that's flowing through that has a trade or business. But it is possible for an individual to have a net operating loss. Net operating losses are calculated differently for alternative minimum tax purposes. So first of all, you need to take into account your preferences and adjustments and come up with the alternative minimum tax net operating loss. And once you've come up with that number, the net operating loss is generally limited to 90% of your alternative minimum taxable income, which means it is possible for a taxpayer to not have a regular tax liability because the NOL wipes it out, but to have an AMT liability because even though the AMT NOL was great enough to wipe out alternative minimum taxable income, it is capped at 90%. And because there are these different adjustments, you are required to track your regular tax net operating loss as well as your alternative minimum tax net operating loss. So I've given you all the bad stuff. Is there any good news? You may have heard of alternative minimum tax credits. They do exist. So when your regular tax is greater than your alternative minimum tax, you can use an AMT credit from the prior year to offset regular tax. The problem is that not everything that causes AMT will generate a credit. So I mentioned the preferences and the adjustments. Typically a preference, which is that permanent add back, is not going to generate a credit. It's only the adjustments that are going to generate credits. So if you have the stock options that are added back, the incentive stock options, remember, the gain or loss on sale of property, and the depreciation adjustments, if those items generate alternative minimum tax, then you do get a credit, and in a future year you can offset your regular tax with that. And so this is helping to smooth out the timing of payment of taxes, in addition to making sure that taxpayers pay their fair share. So, but the credit does help if you are subject to AMT under certain situations. It's not an extra tax, it's more like an early tax. So in summary, today we learned that alternative minimum tax is a second tax calculation and every taxpayer must make it each year. Although this was originally intended to affect the wealthy, for a while alternative minimum tax was really hitting the middle class, but recent tax law changes have attempted to make this more of a higher income, higher taxable income, higher wealth tax. And as advisors, we must be aware of tax benefits not allowed for AMT, and we absolutely must consider alternative minimum tax calculations when we're planning for our clients.